For options, it is February 13th, 2018. Presented materials for educational purposes only and should not be construed as personalized financial advice. Past results are not necessarily indicative of future performance. For those of you joining the recording of this, welcome. Discover Options is the educational arm of OptionVue Systems. Been in business since 1983, primarily involved in the high-end options analytics field, software that you can subscribe to, and encourage you to visit OptionVue with the VUE, OptionVue.com, or DiscoverOptions.com. Today I want to talk about an ongoing forensic audit, so to speak, of a huge VIX trader and the position that this individual has taken since July of last year and has been rolling these positions. Obviously, with last week's wild VIX ride, the position changed quite a bit since we discussed this a few weeks back. So let's go ahead and I'm going to do a review of the VIX element and his position starting in July, moving forward with all the rolls, and then we're going to slow it down after the January 12th roll and see really what happened with this last week's action. Okay, so let's do a review a little bit quick here. And this all started back in July 2017, Wall Street Journal. Front page of the business and finance section, you can see here an article that explains clearly everything about the initial position, even prices and everything here to kick it off. And here's what we had, and I put it into OptionVue and analyzed it and explained it. So let's go and take a look at the mechanics of the position. And this same position was rolled several times using the same strikes, just simply rolling it out months at a time. So here it is in OptionVue, and I'm going to explain what you're looking at because I know that folks are going to join us in the recorded version. I just want to explain what it is you're looking at so I don't just assume that it all makes sense what you're looking at. So this is the OptionVue matrix for the VIX options, and the way we like to lay this out, instead of having one column of calls and puts, calls on the left, puts on the right, what we do is we lay it out in a grid where we have calls on top and then the puts down below, and then we go out each expiry going left to right, Sep, October, going on out like that. And so what you'll see then are the actual contract, the strike prices here in the calls. And what this trader did is, back in July, shorted or sold 500,000 shares of the 25 calls in October with 89 days to go, concurrently going down here to the 15 calls and buying 260,000 of those, and then selling 260,000 of the 12 puts. This is when the VIX was back at 9.36. So when you analyze this position, this is the graphic analysis that we have here in OptionVue. You have an x-axis and a y-axis. Real quick, as the VIX goes up, okay, we move over here, we're in the 9s, we move to the right, and it goes to 15, 20, 25, all the way out here to 44.91. Then on the left side, we have the dollar or loss amount of the position itself. So then you see the position as of 30 days from now right here, so that in 30 days, if the VIX goes up to 15, the position would be making something around $100 million. All right? Quite dramatic, right? And then this solid line is what the position would be at expiration 89 days from now. So this is how we like to model the positions in OptionVue on the graphic analysis screen. Let's break the position down, same position that was rolled. First, the position involved a ratio right. Okay, plus a naked put. That's the breakdown. So we're going to look at the ratio right, and then we'll add the naked put on top of it. First off, just the ratio right. This is when you buy 1 unit at the 15 here, and then sell 2 units up here of the 25s. Okay, so if you're and the original price was at $1.45. Okay, spending $1.45. Bringing in 2 at 45, so you're bringing in 90 cents, spending $1.45. That's the ratio right. And when you model this out, this is what the position looks like. If the market doesn't move anywhere, okay, well then you're going to lose a certain amount of money. It's limited to how much you would lose. If the VIX does go up, and goes to 15, 20, 25, well, at 25, at expiration, you're making several times what it is you're risking here. And that's the ratio right. Now, what this trader did is he added on a naked put to then lift this whole thing straight up the screen, bringing in some premium to then lift the whole thing straight up. And so he went down here and collected 80 cents, okay, and then lifted the whole thing straight, or excuse me, at 75 cents, lifted the whole thing straight up the screen. And when we superimpose this final position with just the ratio right, you can see that by lifting up the red line, basically then lift it and move the break even from way here to further down. So now, if the VIX climbs and just hits 1180, the trader then makes a little bit of money, breaks even, makes a little bit, and still has that huge upside if the VIX goes up. And so that was the effect. Now you can see here that if the VIX declined down to 8, 6, and 4, well, then he's gonna lose a huge amount of money. Well, what's the rationale here? Back when this was initiated back in July, you could see that the VIX was pretty much near all-time lows. Really, really low. And the question is, really, what's the likelihood it's going to go to 8 and 6 and 4? Very, very unlikely when you go back to 05, 06. It just hasn't gone that low. And there's intrinsic philosophies of volatility that would prevent it from going down to 6 and 4, etc. So that's the rationale here, is that really it's down at its floor. There's only one way it can go, right? So it's just a matter of when. So what VIX Elephant ended up doing was rolling this thing out 3 times because the VIX just didn't, it initially went up a little bit. And at one point, the VIX Elephant was making money, certainly when it was up here at 14, 15, etc. Okay, but then it came on down, and it was pretty clear that this trader was waiting for it to really blast off through the roof and hopefully time it right so that he could make just several times what the risk is. So then time goes on. Remember, there's 89 days left, and when we get to late September, the trader rolled it out, and this was covered in previous inside wires. Another few months goes by, the trader rolls it again, early December, late November, and then what we covered last time was on January 12th of this year, the trader rolled it yet again, each time rolling it and collecting losses. Each time rolling it and collecting losses to the tune of $9 million on the initial trade set in July, rolling it on September 20th, and then on December 1st, rolling it again and banking $1.8 million. The position was down a lot just before that, and on a big day where the VIX, blasted off, he rolled it there, and then on December 1st, that position then lost $33.7 million and rolled it on January 12th, and that's where the story then continues. So up to this point, on January 12th, the trader had lost $44,637,500. Now, I'm pulling this from other publications on the web, looking at OptionVue, getting the times right when I see that the volume kicked in. Obviously, when the volume goes to 500,000 plus, it's a good sign that this trader made the trade right around that part of the day. So with that kind of analysis, that's how we kind of got into this. I've been tracking this whole campaign in OptionVue's portfolio manager, and this lined up pretty much precisely with one of the journalists that has been following this. And their screen looks just like this one, and so that was kind of an encouragement to me that I'm tracking right with what's going on with this trader. What happened next after January 12th? So that's where our story then continues. Okay, here we go. If you went on the web and did a Google of VIX Elephant, you're going to find 2 main publications. One from February 6th by Greg Calderon here at Bloomberg, and then another one that kind of teed off there. But this guy, drilled down into Bloomberg, and but this this publication here at Varchev Financial Services kind of misses the boat in terms of the timing. And I think Calderon gets it right as to the exact date. This guy, though, drilled down and found the prices using his Bloomberg Pro terminal. So I'm going to use the prices on the Bloomberg Pro, but the timing comes from Calderon's article as well as my own analysis using OptionVue's backtrader and looking at open interest and looking at the volume figures as we go 15 minutes by 15 minutes throughout each day. So what follows is the analysis I've done looking at both of these articles that you can easily Google and read for yourself. Okay. Let me sip of coffee 1 second. All right, so you see the January 12th roll, and of course scaling here throws it all out of whack. But there's the roll on January 12th. And what happened is that the trader ended up rolling again on this big VIX pop. On this big VIX pop in the middle of the day, and we'll go and examine this, the trader rolled out, closed out January 12th, the position that was rolled on the 12th, and rolled the whole position over on the 2nd, okay, and took off enough profits to pretty much cover everything, all the losses from the past, with just short of a couple million. All right, and because this trader didn't know, was that just an anomaly there on that Friday? Well, Monday comes, okay? Monday comes, and I walked through 15 by 50 minute, and there were no trades. This trader watched this whole thing blast off. We're going to look at what the position did on Monday after he rolled it on the previous Friday. Okay, then the following Tuesday morning, okay, when the market was up here right around when the market was at 41, he executed a very interesting scale out. A scale out, leaving a position that is, by my analysis, still on this morning as of 9:30 a.m. Central Time. Okay, so let's go and take a peek at this adventure. So let's go first to the January 12th. After that roll on January 12th, here's where the position is. The trader rolled it out, banked 44 million in losses, and is waiting for the market to take a plummet and for VIX to go up. January 12th. On the 2nd of February, that's the Friday where we had the big market pullback, VIX blasted off. The VIX was then at about 14.62 as of 10:15 Central, when I calculated that the trader then rolled, or excuse me, was at that point adopting right around a profit of around 42 million or so right here, sitting on 42 million in profit at that point. Okay, now that's at 10:15 Central. By my estimation, and at these prices at that time, looking at volume and everything, that's when the trader then rolled the position, closing out the Feb position, closing this out, opening up the same position over in March. This is on the morning of Friday when the market began to tank and VIX began to blast off. And this is kind of a pattern that we've seen, is that as soon as the market moves and he can scale and he can roll and take enough profits to roll and be even, that's what he's been doing. That's what he did last time. But we didn't know that Monday was coming. So let's just go and take a look at Friday's close. So rolling this, and as of Friday's close, here we are. Okay, making just a little bit, because remember, the market kept going down on Friday, right? Finishing up in the evening pretty low. The market was, really going down. VIX had climbed to 17.37 by the close on Friday, February 2nd, and Monday's coming. Remember Monday? Monday came, and here's what happened, and he didn't make any trades then. Now, what happens is Monday comes along, okay? Trader makes no trades as VIX goes from 17 all the way up to probably 39 and pulls back a little bit. So let's go and take a look at the position. This is at the open on Monday, the 5th, and we move over to the midday. So, making a little bit here, Okay. We move over and we're making a little bit here, you know, looking like around 13 million up on the midday of Monday. And then at the close of Monday, now the trader is down, you know, roughly 2.5 million. So from being up 13, now being down over 2 million, all right, the position traversed, you know, way over here, all the way over there. Very interesting. So Monday evening comes, and you know he's probably freaking out. I mean, if the VIX keeps going up, look at all this. Zzz, boom. You know, crazy. So with that said, let's now go look at this. And what happened is on the 6th in the morning, okay, the VIX gapped up, all right, wobbled around, and it went up and came back. And right around 41 or so is when the trader made a very interesting scale out. So on Tuesday morning, okay, the modeling is way down here, and he's down like, remember, it gapped up, and so he's over here. And what I did is I clicked, I'll go with this a little bit. I just clicked this button to snap all this over here. These lines were over here, and the modeling is very difficult here way out this far. So you can snap the T+0 line using that button right there. But the point is, the position is down over 7 million, just this position. So let's go and look at what happened. Here's what the roll. This wasn't a roll. This was an interesting scale out that he did. And he did basically 3 legs. He scaled out some of the position here, and he did 260,000 contracts of all 3 legs, 260, 260, and 260. And these are the prices. Now that I'm showing you the original prices. So when you pencil this out, the original price, he bought, remember, he shorted 525,000 at 62. He's now buying roughly half that position back at 490. And this market price was not the price he got it off. He had to buy it back at 490, losing money on these calls up here. But look at this, okay? Down at the 15 calls. Okay, he originally bought these for $1.83, selling them for $8.20. I have it over here, $8.20. The market price as of this time was at $7.60. So these prices here that was reported in the article from the Bloomberg analysis do conform with what OptionVue says is that option's high and low for the day. It's within that range. So I did confirm that. So there's clear profits taking with these 15 calls, and then also profits taking down here, buying back 260,000 of these puts, sold for 76, buying them back for 30 cents. When you run these numbers, the trader scaled out of this and harvested $66.3 million of profit here, of realized gain, leaving a position that's very interesting. So when you look at the realized trade, the realized positions in the campaign, the first 3 closed positions lost money, okay? And then he rolled when he was just 2 million short of making up all the losses. And then on this scale out, the realized gains now work out to about 63 million. But, and a huge but here, let's go and take a look at the existing position that he has on. The existing position he has on is down 85 million. Okay, let's go and take a look at that. This is how the position looks when you analyze it. Okay, when you analyze the position, let's go back. What's the next screen? Boom, boom. No. Let's go back and look at this. Okay, what remains here is 265,000 of these shorts up here. Okay, what remains over here is 2,500 of these and 2,500 of those. So when you then analyze that, okay, 2,500, 265,000 of those, and 2,500, the current gain and loss on the existing position, it's down 85 million. Now, what's the rationale here? The VIX is at 41. VIX is at 41. There are 43 days remaining in the life of this position. Excuse me while I run up and take a look at the VIX chart real quick. The VIX is at 41. Let's go further up. Excuse me while I go jump all over the place, but I want to go look at the original rationale. Keeping in mind 41, the VIX now over here came up to 41. How often has the VIX been at 41 or higher? Well, here in 15 it was. Here in 11 it was. Here in 2010 it was over 41. And of course you'd have to go back to 08 and 09. And certainly there's a chance that we could have an event like that, but we all know that there were fundamentals driving this nastiness here. But look at these other market pullbacks and plummets here. They quickly corrected themselves and went the other way. And that's what this trader is doing. And he's saying basically, yeah, it's at 41, but whenever it's gone up above 41, short of having some serious fundamental problems like 08 and 09 had, it's just a matter of time before it's going to then plummet back down to the 30 level, right? So with that in mind, let's go back down and take a look at the existing position. And you can see that as the market then pulls back, the VIX goes back down, all right, and gets down into the 31 and then goes back down into normal territory. And we're going to advance forward in time. Watch how this trade then works out. And by the way, from here, you can click this little button here, and it'll snap all the numbers, all the lines, T+0, over to here and redraw it. All right, just for visual sake. Not that that modeling is hugely accurate, but you can do that if you want flip-flop. But let's go forward in time from February 6th. And we go from the morning of February 6th when the VIX gapped up and came back at 10:15 in the morning. He scaled out, and then the VIX kept plummeting that day such that at the close, the position was now down roughly the same level. Pulled back to 29.94 all in one day. From 41, when he scaled out, zip, back down to about 29.94 there. That was on the 6th of February. Now what's happened since then? Well, it's jumped around now, but as of this morning, okay, the position, instead of being down 85 million, is now down 42 million. So in the course of that time, February, in the course of a week, right, the traders basically made back roughly, $43 million on this. And of course, as the VIX goes down further over the course of the next 36 days, if the VIX does come back here, you can see at expiration the position is being modeled that this position would then actually be positive 18 million. So what's the total? Where does the traders stand now, inclusive of everything? You had the first three rolls that lost money. Okay, he rolled and pretty much made back most all the money short of 2 million. Harvested 66 million, leaving an $85 million loss, but the VIX has dropped such that now the current position is down 42, potentially being able to make 18. Okay, it's a $60 million swing over the next 36 days. Currently, the trader stands, after all of this, at making 21.6 million or so, by my analysis of everything. Here is the continuation of the profit and loss. Okay, beginning with $0. You can see the position or the campaign's profit and loss as we go on in time. And of course, this last week with the VIX flying up and down, you could see the P&L was just crazy, having huge $50 million swing on one day. Just a wild ride. But that's where it stands now, and we'll continue to monitor this as time goes on, and also as other analysts publish their own version of the forensic analysis of what this trader's done. Okay? Any questions, comments from those that are live? Russ or Jim? Okay. Perfect. Excellent. Folks, thanks for joining us. We'll be back next time for the Inside Wire. Take care. Have a great rest of the day. Bye-bye.